Hi everyone, Chad Hoop here. Welcome to my latest edition of Bank It or Tank It. If you're new to this series, I just want to catch you up on what we do. Every week we break down one stock and we figure out whether or not it's a company that we want to bank on over the next 12 months, meaning I expect shares to go higher, or it's a stock that we're going to tank. I'm expecting it to go lower. But in light of what's going on with the recent stock market sell-off due to the coronavirus, I've switched up the series a little bit. Instead of focusing on bank it or tank it stocks, we're only focusing on stocks that I want to bank on. So going on to this, you know the company that I'm looking at today is a stock that I want to bank on over the next 12 months, and it's due to what's going on in the current stock market environment. So we've been looking at a few of these companies lately, but all the stocks that we look at are stocks that you all have recommended. So every week, the stock that I pick is out of a list that one of you all recommended. So please keep those comments coming in below this video. Let me know what stocks you want me to take a look at, and I'll be sure to add them to my list and feature them in an upcoming Bank It or Tank It video. This week's stock is Netflix. It's going to be our feature for Bank It or Tank It, and we had two requests on the company. It came from Himeng and Dennis, so thanks, a big shout out to them for recommending the stock back in February to put on my radar. With everything that's going on right now, it's a stay-at-home stock. It's the first one that we're talking about that's actually benefiting from what's going on due to the coronavirus and the lockdowns and everybody forced to stay at home. So Netflix is our stock for Bank It or Tank It today. Now, before we dive into the details for Netflix, I just want to ask you to scroll right below this video, click subscribe so that we don't miss out on any of my upcoming Bank It or Tank It videos and you get all of my insights that we post here on YouTube. So scroll below, click subscribe, and also make sure you leave me a comment. Let me know what stock you want me to take a look at, because today we're focusing on Netflix. Again, this got brought up back in February, but with everything that's been going on right now, this is a stay-at-home company that's benefiting, seeing a ton of streaming hours as people are just stuck at their house with not much else to do. Streaming's one of the top things to do right now. People are getting back into video games that they didn't have before. I see a ton of people in our neighborhood out on bikes. I'm sure if there was a company that makes bikes, their sales are going through the roof. But really, where most of these people are ended up buying them from, where we ended up buying them from, was Walmart or Target. We ended up going to Target. It's right up the road, and it's easy to just to go online, order it, and we got to pick it up. And then us and our kids are out there riding on bikes today, actually. So it's been a very great environment here to see these unique plays start to come to life and how everybody's just transformed. But aside for a few of these companies, they're just going to get a quick pop. Some stocks that are, make the mask that you have to wear now for the healthcare workers and even for the population, that the CDC recommends everybody to wear masks. Now, those companies that make those are going to see these one-time pops that they spike during this crisis that we're seeing for the coronavirus, but then they're going to come back to life down the road. But for stocks like Netflix or Walmart or Target, they're a little bit different. They're seeing this kind of steady stream of revenue still coming in, but it's far below what they were used to for Walmart or Target anyways. But that can come to hurt them, because these companies that seem to be still doing pretty well are going to have some downside to them because they're getting hit by the coronavirus as well. Think of Netflix, for example. That's our stock today. This is what we're focusing on. Netflix, even though it's a Bank It stock, it's seeing a ton of viewing hours, probably seeing a ton of new subscriptions for people to try and just to get access to this new content. The shows are a hit. We had a Zoom conference, a happy hour with our work, because we're still working, so we're thankful and we're blessed to be able to be working in this environment and helping guide you through navigate this market. But we're all working remote. We're not able to go into the office like we would normally during a normal week, so we're having the Zoom happy hour to still bring everybody together, and everybody's throwing out their ideas about what movies, what TV shows are a hit, and almost all the shows that were being listed were being streamed on Netflix. So we could tell that was a huge hit. It's a hit with our coworkers, it's a hit with my kids, my wife, everybody's streaming on Netflix. And it tells me one thing, that Netflix is by far winning the streaming wars. Now, Disney Plus, it's great for kids, and some of these other content providers that are having streaming channels, they're all great, but they're very specific. Netflix has such a broad range of content, and now that's their front and center platform for producing new content. So it's a great reward there for subscribers that they get this brand new content on almost a monthly basis. But that's the downside that we're going to see for Netflix due to the coronavirus. That's going to slow down because production all across the board, from Hollywood, everywhere in the United States, nobody is producing new content right now. Everything's on pause as the entire country is shut down. So that's going to be added cost even for a company like Netflix. And then it's going to extend their slate from where they're looking to release this content. They're going to have an empty period where they really don't have any new series that they produced to draw new subscribers to their channel. And they're seeing this added cost. So that's why once we get into the tech notes, I can show you a better look at this. But I don't think Netflix is a great buy today. It's a stock that we want to bank on over the next 12 months. I believe the shares will be higher than they are today. But my whole overall view about what's going on for the coronavirus right now, the whole country is going to be shut down longer than expected. So we have to brace ourselves for that. And in turn, it's going to mean that stocks are going to head even lower from where they are today. So I'm really looking for stocks to take at least one other major move lower, likely to a lower low than what we saw in the sell-off the other week. So we're going to see another massive sell-off in stocks, and that's going to give you a better chance to buy these stocks that are on our Bankit list that I'm throwing out there week after week during this time. These are great companies to add to your portfolio once we get this next sell-off. These are the stocks that you want to add. So with Netflix today, let's dive into the fundamentals. We'll start with the key stats to see how those stack up. Now here's Netflix's net income, total revenue. The net income's the line on the chart, and then the key's on the left-hand side. The total revenues, the bar's on the chart, and the key for that's on the right-hand side. And you can see that both of these are just moving in tandem in a very nice upward slope. So this is phenomenal to see. It's a very great growth for the company, very steady, very stable, and you can't see them taking too much of a hit right now, even with the coronavirus. You expect their revenue to continue to climb because they're one of the cheapest streaming platforms that are out there, especially for the robust content platform that they have. So it's a very value-added play here, even if the U.S. is in a recession because of the coronavirus and money is tight. I think that's worse for the cable networks, which they don't have sports now. They don't have a lot of extra content because people are pulling things out to create their own streaming platforms. So cable, to me, is the loser in everything that's going on with the coronavirus. Even though viewing's going to be up, the fact that they're missing out on sports and all this other additional content, they're also going to have a slowed down slate of new releases. So total revenue for Netflix, I think, is going to stay very robust. I see this as a very inline projections of what we can expect from 2020 to 2022. So total revenue looks good, but I do see the net income taking a hit here. Like I mentioned, the streaming platforms are expensive to maintain, especially when they're trying to produce new content, as Netflix is, and it's how they really continue to grow their brand. But they're going to be taking on all that overhead, all that added cost right now, and then have to push back their slate from when they were planning on bringing in those new releases. So that's going to hurt the net income, I believe, their profitability here in 2020. So that slope's going to be the one in question. But overall, I love what I'm seeing with the revenues, and I think that's going to help them bounce back in the coming months. So it's a great stock to look at on this fundamental basis. The next thing I want to take a look at is the quick comps, a few competitors for the company, to see how Netflix stacks up. Now, if you know anything about Netflix, they're a pure play streaming content provider, meaning they don't have a platform. They don't have we have Roku on here. They don't have a Roku box. Instead, they're on all the different platforms. They're on Apple TV. They're on Roku. They're built into almost any different TV that you can buy. Netflix is one of the first ones on those platforms. So this is a company that is not like Roku exactly. It's not like Facebook. They're not, this is not social media. They're not in that social world, which is also seeing a huge boost at this time, especially with TikTok, Instagram, this sort of interaction that they can't get now because they're stuck at home. They can find on social platforms. Then we have Spotify on here too. That's a music company. They have music, and I think that's going to take a bit of a hit here because, well, what are some of the most times that you listen to music? It's A, traveling, or B, at work. And right now, most of the U.S. is not at work, and most of the U.S. is not traveling. So I think the music platforms, I don't know if people are really going to unsubscribe because you still might pick it up every now and then, but they're definitely not seeing any growth during this time, and they're going to see some unsubscribe. So Spotify, Pandora, those other music companies, they're not going to see a benefit from the stay-at-home play in the market. Then you have the Walt Disney, which is just a huge conglomerate of all these different platforms, including streaming, but not a great relation to Netflix. But I like to look at all these because they are media-related stocks. And when we look at Netflix, the market cap tells you that they're a pretty large cap stock at this point. 162 billion. The mean for all these companies, 148 billion. Alphabet, Google, the parent company of Google, is the massive company here. almost 800 billion, 769, and then Facebook 450 billion. So we're seeing the two giants, and then Netflix close behind. Netflix is closing in on Disney when you look at this, and that's pretty remarkable because Disney has a huge content platform for streaming, for cable, and also their parks. So they have a very robust content and very widespread, and yet here Netflix is gaining on their heels for market cap and expected to shoot past Disney Corporation. The short interest for these just gives us a gauge of how bearish investors are. Netflix coming in at 4.2% of the shares outstanding, so they're below the mean of 5.4%, and some of the highest, well, it makes sense, World Wrestling, so they're seeing slower growth. They try to do some shows without crowds, but it just didn't have the same vibe. Then we have Roku. They're high short interest as well, and that's because their stock really shot up the other year, and it's kind of held that elevated level, very volatile stock, but until recently it started to break down, and that's part of the reason they still are carrying quite a bit of short interest. And then the price to earnings ratio, this last one, and that's a very value-based metric, but when you look at growth stocks like Netflix, you get these high multiples like 89 times earnings. It's incredible. It's extremely high. The mean is 21. The average for the S&P 500 is less than 20. So you see these high price to earnings ratios and you think that it's a company that's overvalued. They're paying way too much per dollar of earnings for the stock. But when it comes to tech related stocks and stocks that are really growth oriented, you're going to see these enormous price to earnings ratios. And then you can look at World Wrestling, you see they have 40 times. So that's kind of the flip side. You'll also see stocks when they're losing money start to have high price to earnings ratios because investors are basically waiting on them to come back in the growth, in the profitability, and they're keeping those price to earnings ratios elevated. But for Netflix, it's the opposite. They're coming from a low profitability situation, and investors expect them to be at a much higher profitability situation after their many years of growth in the coming years. Then we flip over to compare their total revenues and their total net income 3-year compound average annual growth rate for Netflix and how they compare. And you look at the total revenues, this is top of the line. This is money coming in the door. New subscriptions, 31.7%. It's a pretty remarkable growth rate. You can see these other companies in the media business have seen very solid growth. The mean is 25.6. That's an excellent number, but Netflix is even better at 31.7%, growing their top line. And you look up at some of these other ones like Disney, they're at 10.8%. So you can see that their growth path is really slowed down. They're already everywhere. They're already so giant that they're struggling to grow at 10% of their revenues, whereas Netflix is 3 times that at 31%. And that helps explain why they have such a high price to earnings multiple, because they're growing 3 times as fast as some of these other large cap stocks. But you can see some of these other ones have experienced very fast growth too. Spotify, Roku, Facebook, all above 31% growth. So those are growing rapidly as well. And then the net income, this is on the profitability side. They want to see how many dollars they're actually keeping from the revenues they're bringing in. And Netflix has a tremendous 3-year average growth rate of 115% per year. The mean is just 18%. And you can see some of these companies that just have a dash. It's because they don't have any positive growth over the last 3 years. They might over the last 1 or 2. But for this metric, they have to have 3 years of earnings growth, and it has to end up being a positive number. So we can see that Netflix here is absolutely crushing it on the profitability side, and investors love that. That's your dream when you have a growth stock that's finally coming in to this enormous amount of profitability, and then it's continuing to grow and laying the fundamental legwork for this company to just continue to rake in the profits. I mean, they've had to spend on their new content, but they've been doing that for the last couple of years, and they're still seeing bottom line growth. So that's very exciting to see. And then dividend yield, this just helps give you a perspective of some of the large cap stocks. The mean in the media industry is 3%. So that's fairly high. The average for the S&P 500 is around 2%. But Netflix, again, is just still in that growth phase, so they don't have to turn around and try to pay any dividends right now. They can continue to focus on new content, new areas of growth. And that's a plus for any company, because once they get to the dividend phase, they're kind of done trying to find new growth opportunities. Instead, they're just kind of maintaining and hoping investors continue to buy the stock, looking for a little bit of growth in the dividends. So Netflix right now is still all in on growth, and that's exciting from an investor standpoint. Now for the sentiment reading, we like to take a look at what the analyst ratings are for the company. This is out of 37 analysts as tracked by the S&P Capital IQ platform on Netflix. They have it rated as an outperform 2.15, where 1 would be a very strong buy, 5 very strong sell. So at 2.15 and rated as an outperform tells us the investment community is very bullish on the stock. Despite what we're going through right now, their ratings haven't changed, and I don't think they're going to see this number fluctuate much because of the huge opportunities that they're going to have. You're going to see the stats skyrocket for a stock like Netflix based on what's going on in the economy right now. Their viewership, their subscribers, every metric that they're basically going to be looking at is going to be enormous over this period that we're stuck under a lockdown. So Netflix is getting an outperform rating by the analyst community, positive for its sentiment, and I think it's going to stay that way. Now we'll turn over to our last piece that we want to take a look at, and that's the technicals. And this is where we're going to find our key levels and understand how to trade the stock in the coming year. All right, so this first chart that we're going to pull up of Netflix is one that we've been looking at over the last few weeks. It's been the chart that we start with because it helps put the recent move in perspective. So this is what's called a logarithmic chart, where basically you're just looking at the price move is an equivalent on a percentage basis, whether or not it's from $1 to $2, which is a 100% move, or $200 to $400, which is a 100% move. The price doubled. 1 to 2, 200 to 400. The price is doubling. But on this chart, the distance on the right-hand side is going to be the exact same from those. So it helps measure the size of the moves throughout time, because otherwise it just looks like a huge slope. And we always take a look at that before I flip over to our chart with the key levels. But this, you can see Netflix, it goes back to 2002, and it's had some major crashes for the stock. I mean, it was basically zero during the tech bubble bust in 2002. It was extremely lucky to survive that move, and then it built up enough momentum, a lot of volatility, and you can see the stock basically consolidated after the tech bubble, and then it held from 2004, the highs, all the way to 2009. So this was after the financial crisis. You can see this stock was not impacted as much as most during the financial crisis. It was still a steep sell-off, about 50%. But for the company, for what these types of moves actually look like, I mean, you would have been looking at a much major move, 60 to 80% more than likely for a really massive sell-off for a tech stock, volatile stock like this. But during the financial crisis, it moved about 50%, nothing too crazy. Then had an enormous run higher, then a massive sell-off from that. It got hit really hard there in 2011, 2012. But since then, it's been pretty smooth selling. Stock has been on a tear all the way up until about 2018. And then you can see that now we've been in kind of this clunky, volatile period, kind of just going back and forth. And the little recent sell-off and bounce are really just minor moves when you look at it on a chart like this. This is really nothing going on up here on the top right-hand corner of the chart. But then when we take it off the logarithmic scale, you can see these look like some massive moves and a lot of volatility that we haven't seen in the stock for a while, which was kind of the case. It's been on a nice run up, but these moves down here that look much smaller were actually major sell-offs. So that's why we like to take a look at it in a logarithmic scale, just to put it in perspective. Now, here's the chart with our key levels to watch. This is what I'm paying attention to for Netflix, and I'm going to talk about what I want to see before I buy the shares. So either way, when we look at Netflix, it's benefiting from the current environment. It's going to have some struggles, but it's a winning stay-at-home stock that we want to bank on over the next 12 months. Now, one of the first things I want you to look at is the 200-day moving average. We use this largely as a sentiment indicator, especially when it's not holding up much for a key level for price. But right now, the price is above the 200-day moving average. 200-day moving average is a little flat, though. I wish it was sloping upwards, and then a price above it, and then that tells me that the investor sentiment is really bullish on the stock. So right now it's just kind of iffy. It's not really giving us a clear indication, but we know from the analyst ratings that they are extremely bullish. But the 200-day moving average could be key going forward as the stock looks to finally break out of this wedge pattern that I've highlighted here. We have the top red resistance line coming down and the solid red resistance line, and then the solid green support line is what forms the wedge. But you can see if you take this recent peak out back in 2018, the little bubble there, then we have a nice dotted line here of a red horizontal resistance line, which ends up creating more of an ascending triangle pattern. Now, all these patterns kind of get wordy and sound a little bit weird, but they actually have a lot of meaning when it comes to the company and the stock. And not only do we have these key levels, which are my favorite thing about finding these patterns and these key levels, is that you can pay attention to them and you understand what it means when they break. But these patterns of consolidation after a massive run up usually are continuation patterns, meaning that the stock usually continues in the same path that it was in before. So we get this major run up, then a stock over the last 6 or 7 years, and then it hits this consolidation period. And then after it consolidates for a little bit, usually it continues to break out and heads much higher. So that's one of the reasons why I'm comfortable putting this on my bank it list today over the next 12 months. But when you look at these two resistance lines here really converging really around this $390 area, that tells me that we have a major resistance right here. And I don't think we're going to see the stock close above 390, let's say 395. We want to get back, really break out above these lines, because as you can see, the areas are kind of just that. They're key areas for us to pay attention to. It's not necessarily down to the penny or the dollar as far as when it's going to turn around or when the breakout is. Well, right here, we had a little bit of breakout above these previous resistance lines, but it wasn't enough to send the stock soaring. Instead, the coronavirus fears continue to weigh on the stock, and it pulled back quite a bit. Then we see the nice rebound as investors realized, hey, this is a stock that's benefiting. But again, once they think about how delayed their new releases are going to be and how much overhead and cost that's going to weigh on the stock, I see shares coming back down to this green support level. It may not get all the way there, but I would say that below 320 is a great opportunity to look to accumulate some of the stock. And if it falls below this green support line, then you want to get out, because at that point it's breaking down below these wedge and triangle patterns, and that means it could have much, much further to fall. For long-term investors, when I say that this is a stock that I want to bank on, and maybe you're like, well, okay, I'll just add it today and not worry about it. But adding at $380 or adding at $300 is a big difference. That's $100. That's a 25% difference in the stock from where you're buying it at. And this could take place in the matter of weeks. So all you have to do is pay attention to two things here. The time that you would want to buy this stock is A, if it breaks above this red resistance line, closes on a closing basis, so the price closes above $395 a share. At that point, it's tempting to buy and continue to ride higher from there and just hold for the long term. But if you're looking to trade it, you can also get these breakout moves. Once it closes above that, usually a bunch of follow through over the next couple of days as it continues to push higher. On the flip side of that, since we haven't broke above that, right now you would trade it on the downside. We're expecting the stock to move lower. I'm expecting it to get back to this green support level the whole way. So below $300 a share would be the full expected move that I want to see from the stock. But if it gets below this 200-day moving average, once again, then I think that's low enough to start accumulating the stock, or at least dipping your toes in, buying some of the position if you're a long-term investor. If you're short-term, I like to let this really play out and get a little bit closer to $300 a share before I try to play the upside, because otherwise you're risking too much. If you buy it around 320, then you're giving up this much downside that it's still in an uptrend. It could fall to $290 a share or so, and then at that point it could drop sharply down to maybe 260 overnight. And that's, you look at the volatile price moves here, that's nothing for a stock at this price range and seeing this much volatility. So, and at that point, you're really taking a massive loss for short-term traders. Long-term, it really doesn't matter, but for short-term traders, that's a big loss to take. So it's one that you want to pay attention to and really let the full trends play out. In other words, you don't want to jump in halfway down or halfway up. You want to get in around these key resistance and support areas, resistance in red, support in green, and then that gives you your key level to look at. So once it breaks and closes below these key levels, then you know just to get out, move on to another trade, because it just didn't work out. So that's how I would be trading Netflix over the next 12 months, with more emphasis on the upside, expecting a bullish breakout of these wedge patterns in the coming months. Now, I always like to run through my checklist real quick on Netflix. Even though we know it's a bank stock, I like to recap. Well, we looked at the fundamentals. The net income was trending higher, right in tune with the total revenues, but we expect net income to take a little bit of a hit. I'm sure the whole investment community is seeing that right now, but the revenues are going to continue to grow, and down the road, that's going to continue to help the stock improve and have a foothold in the industry. So it's going to get a check mark for the fundamentals. When it came to the sentiment, it was a little iffy. The analyst community was very bullish, but then the 200-day moving average was flat because of the consolidation that we've been seeing on the price chart. So we'll give it an X for sentiment today, because even though the investment community, I like to use price to kind of outweigh what I'm looking at for the sentiment. But then when it comes to the technicals, as long as this stock stays above that green support line, it's in this ascending triangle pattern, and it's been in this consolidation phase for years now. So I'm expecting a major breakout for the stock over the next few years. The stock, it took a lot of time to sit here and consolidate. So we're talking over the next decade. We expect the stock, after it breaks out of the consolidation, to continue to rip higher. And as long as it stays above that green support line, it gets a check for the technicals. So Netflix is a stock that stays on my bank it list today. Now, we talked a lot about Netflix and how everything that's going on with the coronavirus and the economy, how all that weighs into Netflix over the next few years. And that's a great play right now to jump in and buy and hold this type of stock. But if you're looking for shorter term trades and looking to capitalize on some of the key trends that I'm showing you and talking about some of these moves from the red resistance to the support just inside this wedge pattern and attempting to set up for a breakout eventually and how to play that, well, the number one way is with options. And that's my favorite way to trade, especially in this volatility. It's tough to buy options, but there's incredible opportunities out there that you can use to pick up on the bounces, on the pullbacks in the stock market, and lock in massive gains week after week after week, even in this environment. In fact, right now is a great time to learn how to trade options, because there's plenty of opportunities coming up as these stocks just jump in a single day for you to take your profits off the table and move on to another trade. So if you want to learn more about trading options, scroll below. I'll have a link below this video after you click read more that I'll tell you all about my favorite way to trade options, how right now is the best time to get in, because what we're about to see over the next few weeks are a ton of incredible opportunities due to my strategy that I follow around earnings season, but not buying before earnings. Instead, scroll below, click the link to learn how I trade earnings in the stock market and why this year, this volatile season, is going to be filled with a ton of opportunities. So check that out. And that's all I have for my video today. Thanks for tuning in. Be sure to leave me a comment below. Let me know what stock you want me to feature in my next Bank It or Tank It video. Until next time, I'm Chad Chu.